So required minimum distribution. So it used to be once you hit age 70 and a half, if you had money in the IRA or 401k or whatever, you had to start taking money. There was a bill a couple of years ago that changed that to 72. So now it's 72 instead of 70. And basically, if you put money into a tax deferred plan, like a 401k, traditional 401k, traditional IRA, traditional set, traditional this, that, and the other, that means when you put the money in, you got a tax deduction back then. And the deal is when you take it out, you have to pay taxes at that future date. And they want to make sure you start taking it out. So that's where the RMD comes in. Basically, they'll look at your account balance and they'll look at your age and they'll do a calculation. There's a table based on your age and what percentage of the portfolio needs to be liquidated and distributed so that you pay tax on it. Basically, it starts off at like 4% and then it graduates from there. I think if you're like 96, it's 50% has to be distributed. So basically, they want to make sure that the tax eventually gets paid. And you don't have a choice about this because it's just the law. And every administrator of retirement plans will do this whether you want to or not, because they don't want to get caught up on penalties and things for not complying. You'll get a notice from Administrator X. It will say your RMD this year is blank. And where do you want it sent? That's the extent of the questioning that they do. So it is taxable income. Just if you have profits from a company, you do not pay employment tax on it. So you don't pay Social Security, you don't pay Medicare, but you do pay income tax on it. If you have enough of it, you might pay net investment income tax, or you might pay additional Medicare tax, but you have to be up in 6 figures before that happens. So that's just something to be aware of. Now, there are things to do with RMDs. So think number one is that if you have multiple accounts, the RMD for you specifically is based on your global portfolio value. So if you have different accounts that do different things, you might want to take your RMD from account number one and have that satisfy your total obligation for the year and leave account number two and account number three alone with no distributions. Now you have to coordinate with the administrators to make sure that happens. And so that they all know that the RMD is being satisfied just by this other account over here. But you personally just have to make sure you take a total value from your total accounts. It doesn't have to be RMD per account. So that's something that people don't understand a lot. Another thing you can do is a QCD, which is qualified charitable distribution. So if you're over age 70, and if you're in RMDs, you're automatically going to be over age 70. And you are charitably minded and you're giving cash to charities, you can have the administrator send the money directly to the charity. And that money never hits you personally because it didn't go to you, it went to the charity. And the money that you contribute to the charity through that distribution counts towards your RMD. So let's say you have an RMD of $15,000 this year, and I'm going to give 5 of it to whatever, Humane Society. I tell my administrator, hey, give 5,000 to these guys over here, send it to them, and then give me the 10. And then I'm only going to be paying tax on the 10. So that's a more efficient arrangement as opposed to taking the 15 and giving 5. And it's because of that standard deduction, itemized deduction hurdle that we talked about earlier. Same issue. If you're charitably minded, again, don't let the tail wag the dog, but if you're going to give money anyways, give it more efficiently to a QCD. And then the other thing is that inherited IRAs under the Secure 2.0 Act, there was a little bit of confusion about this that we finally got some regulatory clarity over the last year or so. Basically, if you pass away and there's still money in the account, it's going to go to your heirs. Let's just say it's one heir for simplicity. That heir is required to take out a 10-year series of RMDs that's going to drain the account balance. So even though you got away with not paying tax by passing away before all the money came out, the person who inherits that account is still going to have RMDs for 10 years to drain the account to make sure those taxes get paid. So if you do traditional plans, that's the deal. You're putting in money up front, tax break at that point, tax hit on the back end when you take it out. Now, the alternative to that is a Roth arrangement where you're putting in money after tax. So there's no tax break up front, but similarly on the back end, there's no tax impact, there's no tax hit, and there's no RMDs because of that. Just the different approaches, and depending on your age, Roths might not have existed back when you were putting that money in, but now they do. So if you're a young person at this point, you can think about, do I want to have a tax break now and tax it later? Or do I want to take a tax hit now and not have a tax hit later? So that's the fundamental choice. And the answer depends on your assumptions about future rates of growth, future tax rates, and what your lifestyle is going to be. So it's all a bit up in the air, to be honest, as far as what your assumptions are going to be and how that models out as far as which way comes out better.
Okay.